great future. We're talking real money.
Do you believe in magic? I think you do. I really do. And I kind of thought we got over that as a species, that we really didn't believe there was magic. I thought maybe we did it like in the 60s when Bewitched premiered on ABC, and then the next year I Dream of Jeannie, both of which made magic look ludicrous. And so I figured we got over that, but apparently we didn't. We're going to talk about your magical thinking and the dumb things that it causes you to do on Talking Real Money. I'm Don McDonald. That's Tom Cock.
I'm over here twitching my nose for higher returns. I hope that works. But I guess not.
It doesn't work. Well, that's, I want to give you a phone number. It's 855-935-TALK. That is how you call us. And look, I'm checking the lines.
Yes.
Oh, yeah, they're open. There they go. They're all open for you right now. 855-935-8255. Magical thinking. What magical thinking am I talking about? I'm talking about the belief that we have, particularly those of us who invest, that there is some sort of magical investment vehicle out there. There's something special. There's something maybe a little complicated. There's something unique and something that it's just outside our grasp. And if we can only grab it, we're going to do really well. And one of those things it's getting a lot of press lately because the president says, hey, everybody should get to play in private equity. It's private equity. And there was a great piece by Jason Zweig in the Wall Street Journal about a money manager who used to work for Vanguard managing lots of money, started managing the portfolio of a small community, and discovered the downside of private equity.
Yeah, I like the way Richard Auerter, I hope I pronounced that correctly, put it. He said, when I bought illiquid stuff, I was getting a return premium for it. Here's a trifecta of bad things that happened in this case. Lower returns, higher fees, and no liquidity. Now, with alternative investments or private, whatever you want to call it, you can pretty well guarantee two of those, higher fees and low liquidity. Right, you're going to pay more, and you can't get the money.
Those are the two mega downsides. But then there's the other one. We'll get to that one in a minute. But the fact is, why would you want to put your money in something that is hard to get out of?
Exactly. He makes a very good point. So what they're talking about here is I'm sure you're not familiar with the Indian Shores, Florida area. I don't even know where that is in Florida.
Down southeast. It's between between Vero and West Palm down that way. Yeah.
Okay. And they have a pension fund for the public safety workers, firemen, et cetera. $21 million. So this is not a big fund. I mean, it sounds big with $21 million, but that's a pretty small player when you look at some of these pension funds. But they took 4% of it and put it in a thing. I love how generic this sounds. The U.S. Real Estate Investment Fund.
Gee, it sounds like an investment fund in U.S. real estate, doesn't it?
Oh, yeah. Well, yeah. Everybody should be in that. It's the U.S. Real Estate. Okay. They put $800,000 in that, and it has $8.3 billion. And then they found out, well, okay, not only, and how much could they get out? There was a very small number when they went to try to cash some out.
It depends on the year. They in 1 year they got out 7.5%, but then last year they tried to take money out and they only let them take out 0.2%.
Remember, the money needs to come out to pay these people their pensions. Yeah. Right? I mean,
right.
And the good news would have been, well, that's offset by the huge return we got. Not so much. The average annual return, 0.7.
That's a 5-year average annual return.
5 years?
Less than 1% per year, and you're taking additional risk.
You're taking additional risk.
Paying higher fees.
Yep, exactly. A Vanguard's real estate fund and made 3% a year annualized, and it sounds like 300%.
Yeah.
More. So it's, or 200-something% more. Anyway, the point is, as I said, you can guarantee two of those, no liquidity and higher fees, a lower return you would not have expected, I think, because of the investment that it's in.
But here's the thing. we all believe because we hear about the Yale endowment or the Harvard endowment or whatever it is endowment, that they have these billions of dollars, and a chunk of those billions of dollars is invested in alternative assets or private equity or these non-liquid real estate investments, of which there are many. And these real estate investments make huge promises or allude to huge returns, but do they provide them? Well, in some cases, like this one, not. But the biggest issue, I think, still is the lack of ability to get at your money. You're different than an endowment that has 100-year lifespan or more.
When they can put it off, they can wait 5 years, 10 years, etc. But when you're smaller and you got to make these payouts,
or you're an individual who's 65 years old and needs this money over the next 20 years.
Another reason it's a really bad idea for your retirement investments. But this fund manager calls the typical alternative fund a Roach motel. You come in, then you only get out when they liquidate an asset, and you don't know what the price is going to be down the road, but the range is probably so wide you could drive a Mack truck through it. It's scary, honestly, when you read things like this, because this is the things that, and people are getting sold on, as you said, Don, sort of the exclusivity, the fact that only accredited investors used to be able to get these things, and now everybody can get on them.
And then there's the rest of the story, too, because there's so little information that you get. There's very little transparency. So you could have some really terrible investments in this portfolio, and they can tout them as good because there's no secondary market.
Tom and Don are talking real money.
Hi, Don McDonald here. So, what's your plan for retirement? No, really. What's the actual plan? Because hoping the market goes up, stockpiling random investments, and praying your gut instincts are smarter than Wall Street is not a plan. It's a guess. And when the market gets bumpy, and it always does, guessing leads to second guessing. And second guessing leads to panicking. That's why you need more than a portfolio. You need a purpose, a strategy, a real financial plan built just for you by a 100% fiduciary advisor who's legally obligated to act in your best interest. Imagine that. Start your plan today with a free, no-pressure meeting at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because your future deserves more than crossed fingers and wishful thinking. By the way, no sales pitch, no obligation, just smart help for real people who want to stop guessing and start planning. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
And you can talk with us if you call us at 855-935-TALK, 855-935-8255. I want to wrap up this portion of the story of these private equity, illiquid investments with a quote from Vice Mayor Alverter. It's German. It's Alverter.
Oh, thank you.
Yeah.
Yeah, I have way off.
Yeah, it's all right. I checked. Quote, this was back in the days when he was working with Vanguard running a bond fund.
He managed $750 million in bond funds or something, yeah.
He said, quote, I had to make sure the bonds were priced properly because the bell would ring at 4 p.m. and anybody could ask for their money back. That's the way it works with a mutual fund. Every day you can say, I want my money back, and they have to give it to you. These things don't.
Yeah. And you're headed to a world of trouble there. As I said, the higher fees. And if you think it's going to be exciting with higher returns, there's no guarantee of that.
Exciting. Really? Do you want excitement?
That's what they want. That's what they're asking for.
You don't want your investments to be exciting. They should just be boring. Like watching paint dry or grass grow.
Okay,
yeah.
Let's steal that
where
one
we got
again.
that
Sure.
one. 855-935-TALK. Call us right now. We've got lines open. Let's go to Nashville, Tennessee. Mike, you're up. Welcome to Talking Real Money.
Thanks, Don. My question has to do with when, after we retire, after my wife and I retire, whether we should live off of our taxable investments that we've got in our brokerage account, or whether we should convert the money in the IRA and then convert the money in the IRAs, or whether we should just take the money directly out of the IRAs first. I can give you a little background if that's helpful.
Yeah, that would be helpful, because that's a complex question.
but it's got a relatively simple, basic answer. But go ahead.
Okay, go ahead. Yeah.
So we've got just over $9 million combined. We paid off the house. About half of our investments are in the taxable brokerage, rest in traditional IRAs. We think we're going to retire probably before age 65, but sometime between 63 and 67. We got our money and we used Paul Merriman's advice, and recently we converted most of our tax deferred stuff to the Talking Real Money DIY portfolios for one Fidelity and one Vanguard. So that's sort of where we are. We don't think our expenses are going to reach, say, 5% of our portfolio value every year. So there's got to be money that continues to build up. And so my thought was, does it make sense just to take the money directly out of the IRAs?
Well, let me say, okay, a couple of things here. First of all, we hope you continue to be friends because we appreciate you listening and calling in.
Are you going to make him mad now?
Yeah, no, I'm not going to make him mad. All right. So, okay. So I understood. Half of the money of the 9 is in tax deferred or
IRAs.
Or Roth?
IRAs, regular IRAs. And
No, tax.
See?
What?
Yeah.
Tax deferred only. Yeah.
So half is 4.5 is in traditional IRAs.
And then the other half is in a taxable brokerage style. Right?
Because I thought I heard you said you did something about conversions.
No, that's why I think this is easy.
My question was.
Yeah, okay. I think Don's right. I think it is relatively easy.
You start with the taxable. You let the IRAs ride as long as you can until you have to take those RMDs, which is a while.
How old are you?
I'm 61.
Yeah.
So you're born after. So you have till 75.
Yeah.
It's a long time. I mean, there would be a strategy around figuring out what to do with the $4.5 million that is pre-tax.
What do you mean? Convert it to
Roth?
Roth?
Like conversions or something. I mean, I would want to sit down carefully.
Once he retires and he's in a lower bracket.
No question. But to let that ride another 14 years, get another double out of it, now you're looking at $9 million you got to draw from, and that's going to be a problem both from taxes and IRMA and everything else.
Huh? It's great. What a great problem to have.
Well, I'm just saying, though, that's a tax bill. You pay for your own cruise missile. I mean, it's just a big tax bill. That's all.
Okay, let's talk about your income situation right now, because I really think that enters into this. What do you make now, roughly?
Yeah, right now we're making a healthy amount every year now, so up northward of $500,000.
So you're in the highest of high brackets, basically.
Yes, that's right.
So he's going to get hit if he does conversions.
I think you're right. You wait till he retires, but then I would be
because he said they're going to live on a lot less.
That would just be my strategy then, is to take a very careful look at it.
To simplify, step back, draw from your. Maybe you do conversions later, but just to answer your question, draw only from your taxable. For as long as that will sustain you, which it will forever practically.
Sounds like it.
And you don't touch those IRAs until you have to. But if you can, create a strategy for some conversion so that you now have a third bucket, which is the bucket of the Roth, which never has to be taxed. I mean, never has to be taken. You can let it grow forever.
Yeah, that's all I was saying.
Yeah, but again, the simplest answer is start with the taxables. Okay?
Does it matter that the taxable stuff we've already paid the taxes on that, and that gets drawn out essentially as long-term capital gains versus being taxed at ordinary income for the stuff that's in the IRAs? Does that play into your answer at all?
Yeah, it does, and you're going to get a lower tax rate.
Right, which makes it better for now, and gives you time to then come up with a Roth conversion strategy that doesn't kick you up into a higher bracket, so that you can start getting that IRA money out and avoid the full income tax rate on it later on when it's big withdrawals. 855-935-TALK is our number. Call now.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Once again, the phone number to talk with us, me, Don, him, Tom, is 855-935-8255. That spells talk, T-A-L-K. One of the reasons people get into private equity deals and non-publicly traded REITs is to get access to the asset class real estate. It's one of the more difficult, most people think it's one of the more difficult asset classes to put in your portfolio. However, you can do it very simply with like Vanguard's real estate mutual fund, or now they have a REIT ETF.
Of course they do.
And in their REIT ETF, you have 96 different major real estate investment trusts in that portfolio. Which own tons
hundreds of properties.
Thousands of properties.
Exactly.
Thousands of properties. So therefore, if a property goes bad in the Vanguard portfolio, you don't notice it. But in some of these private deals, bad things can happen, and they can be big.
Yeah, I mean, Blackstone just was they did it. They're doing this surreptitiously. They're selling off a $1.8 billion flopped investment in senior housing. Now, remember, senior housing is going to be easy for everybody to make money because there's old geezers like you and I, Don, that need a place to live here in a few years, right?
Nope. I'm not going.
Staying here.
I'm not going.
I like the view out my window.
I'm not going to those because you know why? I go to those places and I go, why do they have to feel so 1950s old?
Yeah. Anyway,
they're badly thought out. It's really bad.
But a few years ago, everybody thought that's the easy investment.
Shit.
Yeah, exactly. All these old boomers, they got to have a place to go. It was going to be so easy. And then apparently COVID changed a lot of people's attitudes. So you're like, I don't think I want to live there. I'd rather stay at home.
Well, because if you go there, you die.
Yeah, there was that aspect. So demand went down, costs went up. Blackstone, well-known operators of real estate, as I said, put $1.8 billion. It looks like they're going to write off about a third of that, $600 million in losses. Wow. They invested in 9,000 senior housing units, and as I said, it just has not worked out. Some are selling for 60% less than the purchase. So it also shows you how sometimes things look so easy. You can't lose money on that. It can't happen.
And the thing is this Blackstone, this is a REIT. This was a real estate, a non-traded real estate investment trust. But if this REIT was just one of the 96 REITs in Vanguard's fund, then that $600 million would only be a tiny fraction of.
Wouldn't matter.
How much is it? How much is in there? I got to look at
a lot
the
in the Vanguard
in the I'm looking
real
at
estate investment REIT
ETF,
fund.
No,
it's got to be huge. But I mean, again, to me, it just shows this is going to be so easy until it's really not going to be that easy, right?
Let's see. Does it have the yes? Oh, out of $64 billion. So that $600 million is like 1% now.
Yeah, pretty small number. But you got crunched. This is the reason, and I think you kind of poo-pooed this, but I think a lot of people do want private credit, private REIT alternative because it's sexy. It's something that they haven't been available, and the rich people have, and I have not.
Okay, then that's just a flaw in your personality if you think that. I'm sorry.
Be a bit harsh. Okay.
No, I am harsh. You really do have a flaw if you think, I got to be just like the rich guys. I'm kind of jealous that they get the good stuff and I don't.
That's
you know, sometimes they lose a lot and they just don't tell you.
Well,
because they can afford to.
Sure, right. They can move on to the next thing.
You can't. Your $1 million portfolio that you have busted your derriere to build up over the past several decades is too precious to lose in any substantive way. It's too important to you. If you I just got $1 trillion pay package. Okay, then you could lose $1 billion.
By the way, that's even more complicated than we made it sound on earlier show.
It's really it's going to be hard to get it.
It is going to be hard to get I thought it was just they're going to give him a check for
No. He's got to meet all these
stock price
and
EBITDA, et cetera. So it's going to be difficult.
Plus, he has to actually create a fully functioning robot that everybody can afford and will do all the work for us.
I know we discussed this because we had a shareholder meeting the next day. Don forgot to bring up our $1 trillion pay thing, so I guess that's off the table. So
I didn't forget. I thought you were handling
you never
it.
Mentioned. You never mentioned.
You were supposed to ask for the $1 trillion package.
Sorry.
Yeah, I don't have the guts to do that. Hey, our number. What is it again? You remember? Did you write it down?
855-935.
855-935-TALK. Call us right now. Look, lines are open, or we're just going to ramble again.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
Our phone number, once again, is 855-935-TALK, 855-935-8255. Give us a call. We'd love to talk with you. And, well, our regular caller from Sammamish, the Tesla Bull, Jason, is on the line, Tom. Hi, Jason.
I know he voted no on Elon, so I didn't know if he'd been sent to the Ukraine front or something as a result of that, but...
No, I did. I heard you talking about Tesla. I do want to talk quickly about Tesla, and then I also have some questions about the private equity thing you were talking about at the beginning of the show. So first of all, quick numbers on Tesla. Year over year, up 33%. 6 months, up 50%. Year to date, up 13.5%, and that's only because of Liberation Day. Everything went down Liberation Day. So just some numbers, and I knew they would get the pay package. 75% of shareholders approved it. Let's go.
How about year over year sales in like Northern Europe or places like that? How's that going?
I don't have those numbers.
I do. It's been horrible. They're down like 80% in those places. I just read the piece.
All right, I'm going to have to step in, boys. Again,
corner.
we don't believe in buying individual stocks,
No, we do not.
Tesla's also very scary because remember, it was just a few months ago when it was trading at $288 a share.
Yeah. Mm-hmm. So, all right.
The Optimus robot is the future. Okay.
Yeah.
So private equity.
If you could do the laundry and wash the dishes for me, I'll talk to you about it. But until then, no.
I prefer the lawn and the leaves, actually, for me. So.
Probably 8 to 10 years forward to that point. But,
I'll be dead.
All right. So private equity and ETFs. So is this something where I am worried about this? So is this something where it's kind of happening more in new funds, new ETFs that are coming out, and just it'll be kind of clearly noted in the title, or do I need to be checking my existing ETFs kind of on a quarterly basis to examine the holdings to see if they're?
This is going to be a very aberrant situation because it hurts the ETF's liquidity on their side too, in terms of the ability to warehouse and move these securities. It's okay. The best comparison I can come up with, and I think it's reasonably apt, is with a double comparison: 2000 collateralized mortgage obligations, 2008 collateralized debt obligations.
Yep.
All of these complex securities. Now we've got private equity that is basically buying the same kind of flaky stuff. Not the real estate ones, although to some degree, some of them might be buying loans and mortgages that are suspicious. People are always going to want to play in this what they perceive to be grown-up pool, but it's really just too dangerous, and we'll end up biting a bunch of people in the derriere.
But do I need to be checked, like for my regular holder? Like I have VUG, VTI, kind of.
Nope, they're not going to use them.
No,
I don't need to be checking my quarterly statements to see if they're getting into this.
Nope,
right?
they're not going to, because they can't afford to.
That's what I thought.
Yeah.
Okay. And one last thing on the REIT ETFs, I had one of these. I think it was the Vanguard REIT I had a while back. Not very good returns. Like I got.
Oh no, they're terrible returns. We don't suggest owning. But again, Jason, this is the thing this is what we preach. We preach diversification because there probably will come a day when the relative stability of that real estate, that 5%, which is probably all you should have in real estate, is going to help dampen the downturn from your equity positions. That's all.
And it has done that in past situations. So, and again, yes, the fact that it only made 3% a year for the last 5 years looks pretty crummy when you compare that to equity returns.
But when you compare international returns for the...
That's like a bond.
Yeah, it's like a bond. Exactly. It's much more similar to a bond than a stock.
Understood. All right. Thanks, gentlemen.
All right. Thank you. Take care. 855-935-8255. That's our phone number. Give me a call. 855-935-TALK. Yeah, I wanted to share something with you. You're going to like this. You're going to love this.
As opposed to the other stuff
Yeah, as opposed to the other stuff, which was boring.
Okay. Sure.
I am so sick of my email. I can't do this with my Appella email. My personal one.
Yeah.
My personal email. I get so much garbage, and I was starting to go through, and I'm going, unsubscribe, unsubscribe, unsubscribe. And I just go, I'll never unsubscribe to all these. And then they like have 5 steps because they don't want you to unsubscribe.
They do it automatically. If you buy something for people, they just sign you up. They don't even ask me.
I did some research into applications web apps that can do that for you. And I found one that I've tried some in the past. They weren't very good. I found one that absolutely astonishingly good. And I love the name. It's called LeaveMeAlone.
Well, what does it do?
I had it. I linked it to my Apple email, my iCloud email account.
Yeah. Don't give people that idea.
And no, what?
Well, they'll find you and they'll start spamming you even more.
Anyway, I did that. And then I said, go look. And it went through the 100,000 emails in that account or more. There's probably more. It came up with 16,000 emails that I could unsubscribe to.
Wow.
And
excuse me?
16,000.
That's crazy.
I had no idea a lot of these were there. And I kind of just glanced through the list. I just went through it and I went, okay, that's important, that's important, that's important.
Otherwise, no.
And then I went, unsubscribe. And it unsubscribed me to 10,000 email services. And my inbox is already lighter, cleaner. And I get some of them that I want to read, but I don't want to get them all the time. They send me a morning recap.
Yeah, which I like those. I get that from the New York Times, Journal,
it's my emails, the ones that I still want to see, but I don't need to see them right away. It puts them in a format.
Oh, wow.
I'm telling you, and it was $64 for a year. Worth every darn bit.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
One of our favorite things about our job, which is trying to help you deal with money better, is answering your questions. And I love my Friday shows. I just did a show yesterday, or a few days ago if you're listening to the podcast, and I hit my mic, where I got to answer some great questions. And I love doing that. You send them in to me at talkingrealmoney.com, and you speak them, and they go on the Friday podcast. Otherwise, if you're one of those people who insists on using your fingers on a keyboard, or I don't know how you do it with your thumbs on your phone. I do not get that. I watch my wife do it, and I go, how do you do that?
My brain doesn't work right to do that. I don't know.
I have a problem. But if you insist on typing them, you can do that too at talkingrealmoney.com on the contact form, and then they somehow turn into solid form. I don't know how that magical trick works. They become solid. They become like white sheets of.
You see that tree
stuff
right there? That goes away and becomes this question.
The tree's brown. How did it become those?
Oh, I don't know. They add some sort of something to it.
All right. So Tom got the questions, and then he can read them. You have a lot?
I love it.
All right. So we're going to get through some of those while you're not calling 855-935-TALK.
Yeah. This one comes from Spotsylvania, Virginia. When I say Spotsylvania, what comes to mind?
Battle of Spotsylvania.
Yeah, right. Yeah. Civil War.
Yeah, Civil War.
Have you ever been there? I've never been there.
I've never been to Spotsylvania.
As an aside, I just saw this on TV. It's part of another show where it was that show about nuclear war on Netflix. Anyway, the woman was at a recreation.
What's
new
it
called?
The movie? The
Dynamite or something?
Yeah,
House of Dynamite.
The Kate Bigelow.
It's a disturbing film. And at the end, you're like,
everybody hated the ending I read.
I was sitting there going, no. I was actually yelling, no. So what's wrong? They just stopped the film.
Everybody said
anyway.
they hated the ending.
Yeah,
all the reviews was like, that's a terrible ending.
Okay. But the thing that I remembered was that they were at a recreation of Gettysburg.
Oh, thank God. I was
Which
wondering
I would
how
like
this
to go
related to Spotsylvania.
You got to keep working your way all the way around.
Okay, I have been to Gettysburg.
Well, no, I want to go to the recreation with you.
I love Gettysburg.
Yeah, well, me too. I've been there, but not in a long time. But I want not just there. I want to go for the recreation.
For the real recreation thing.
Yeah,
that would be
I'm going to put you right there at the picket, and I'm going to come charging forward. And that'll be that.
At a crawl with your bad knee. I can't make it across the field.
It'll take me a while, but I'll get there. All right. Anyway, thank you, Chris, for writing us from Spotsylvania. Tom and Don, my company is introducing a market-based cash balance plan managed by Fidelity. I'm eligible to elect to put excess contributions into this plan, tax deferred after my 401k is maxed out. Wow, it's a lot of contributions because I think under age 50 you can do $23,500, and over age 50 you can now do with the catch-up $31,000. So it's a lot of money. My concern is I have no input as to how the money will be managed, only a guarantee that I won't lose money.
Huh?
I'm not sure in a cash balance plan that they can do that. Additionally, I won't be able to change my election again until fall 2028. Wait, that's like 3 years from now.
Sounds like a guaranteed investment contract kind of deal or something.
Does sound like a gig. I realize the tax deferral is substantial, but I'm leery of participating. I can roll the money into an IRA or take an annuity once I retire. What's your opinion? I don't like anything where you can't change anything.
It sounds like it's some
That's
sort of an annuity vehicle. It really does sound like it's an annuity vehicle. That's what I am leaning toward. I'm thinking, because, when you talk about the guarantee component, it sounds like it came fresh out of an insurance company's
what a great idea. Never lose money.
Laboratory. Yeah.
Guarantee.
And plus, when he said I can transfer it into an annuity or annuitize it, and those are your only choices.
No, he said he could move it into an IRA.
So it's a qualified.
IRA or annuity.
But it's got an annuity.
It's qualified money, yeah.
It is qualified money.
Yeah, he said it was. It's tax deferred after he finishes putting in the 401k.
Oh, I know what this is. Okay, yeah, but it sounds like the product within the qualified plan is an annuity. It just sounds like it.
I'd
want control over my money.
Well, no, that's the thing. I'd probably just, if I was maxing out my 401k and this came along, I'd just put it in a taxable account if I had other money.
Or if you don't have a bunch of IRAs, do a backdoor Roth.
Yeah, or a regular Roth, depending on your income. But yeah, I would, obviously that would be first. But yeah, I probably wouldn't do this.
I could be, again, knowing nothing about it whatsoever, nothing, I would probably not do it.
Yeah. There you go. There's one less part of a 100-foot fir tree right out the window.
Do you have any others?
Yeah, I got more. You want more?
We have time.
Oh, okay.
You can do another. That was quick. So no,
okay.
I thought you had a clock there in front of you, but maybe not. You just kind of wait for me to decide, don't you? Don will tell me when it's time to leave.
I like it better when my wife looks up and goes, "What day is it?" I go, "I wish I had your life."
What day is it?
It's a Tuesday. It doesn't matter. Jefferson writes us from Thomasville, Georgia. Good morning, Don and Tom. My wife runs a business to 5 people total. I think we did this one. She uses Ed Jones as her advisor. They've been telling her that they have high fees.
Maybe you did it with Roxy, but you didn't do it with me.
Okay. Yeah, telling her they have high, and I've been telling her they have high fees compared to other firms. Would you agree?
Yes.
Yeah.
Okay, that was an easy question. Do you have more?
Well, but she recently started a 401k for everyone. Ed Jones set up with custodian Diatech, and all her current investment options are through American funds. Every fund has at least a 1% expense ratio. I pointed this out to her, and she spoke with the Edward Jones advisor. He told her this is the only options due to the small size of her company's 401k plan at the time. He said, once the accounts get bigger, she might get low-cost index options. Is this true? Thank you.
Yeah, only if they go to a fee-based plan.
Well, but couldn't the plan sponsor just add that on?
They could, but they won't because there's no compensation in there for the broker. He's getting money from the trailer on the commissions. So what they are is, it sounds like they're all C shares by the seashore.
Maybe.
Because they're over, he said over one, right?
Yep.
Yeah, that's C shares. Those are all C shares. Bad
this is a
deal,
bad
very
plan,
expensive.
yeah.
Bad. Get away from Ed. Thanks so much. We'll be back.
Tom and Don are talking real money.
Hi, Don McDonald here. So, what's your plan for retirement? No, really. What's the actual plan? Because hoping the market goes up, stockpiling random investments, and praying your gut instincts are smarter than Wall Street is not a plan. It's a guess. And when the market gets bumpy, and it always does, guessing leads to second guessing. And second guessing leads to panicking. That's why you need more than a portfolio. You need a purpose, a strategy, a real financial plan built just for you by a 100% fiduciary advisor who's legally obligated to act in your best interest. Imagine that. Start your plan today with a free, no-pressure meeting at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because your future deserves more than crossed fingers and wishful thinking. By the way, no sales pitch, no obligation, just smart help for real people who want to stop guessing and start planning. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
For your real life and real future, Tom and Don are talking real money.
You know, the more I've thought about that cash
You got to
value
turn your
fund-
mic on. Turns out, yeah, go ahead.
It
Yeah,
was
you weren't
on
on
the
there
whole
for a minute.
time.
No, you weren't on.
Oh, he didn't turn me on back at the station then.
He didn't turn you back. You're always on.
I'm always
Everybody
on.
knows that 24/7.
The
It's
cash
talk,
value
talk.
plan, I'm pretty sure the more I thought about it, the more I'm confident that is a stable value fund, which is an annuity product.
Okay.
I'm pretty sure it's a stable value.
Well, it's just guaranteed that you're not going to lose money.
Right. Correct.
Yeah.
Yeah. But guaranteed by the
they're-
insurance company.
Correct.
Got to be careful with that.
Yeah, but they're major corporations. Boeing, for example, has one.
Yeah.
Yeah.
Let's go to Delaware.
Sure.
It's not a very big state, so we can just kind of generally go to Delaware. James,
It's easy.
welcome to Talking Real Money.
Yes. Hi, Tom and Don. My question has to do with whether we should switch from traditional 401k contributions to Roth. And to give you a little background, we are in the 24% federal tax bracket. We pay a 7% state income tax. And we have no Roth money at all. It's all in traditional retirement accounts, either
What are your
or-
retirement expectations? Do you think you'll be in a higher or lower bracket when you get to retirement?
I would guess we'd probably be in the same or possibly lower.
Yeah.
Yeah. I would
Therefore,
I would stick with the traditional.
yeah, you take, because especially you add on that 7%.
That
Gets a little spendy.
Yeah.
Yeah. So, I mean, that to me seems pretty easy. How old are you, James?
I am 56, and my wife is 62.
Yeah, and plus this would give you some additional. Yeah, I think Don's right. I would
I
just
don't
take
see
the
any
break
reason.
today. No reason to mess around with it. I mean, you might separately do a backdoor Roth IRA if you had the money, which you could do. Because that would my only concern for you is if all the money saved for retirement is pre-tax money, because then you got to start hauling it out. But sure.
Yeah, I think I would take the bird in the hand right now, because we forget that by not paying taxes today, that actually gives us more money to invest. So we're thinking, oh, we don't want to pay it down the road, but if you don't pay it today, you actually have more money that you're able to put away and watch grow. So I think that continuing to do the regular 401, not the Roth, the traditional is the way to go, and then
take the break.
Maybe do a Roth IRA or a backdoor Roth IRA on the side if you've got additional monies that you can do that with.
Which you can't. You probably can't do the regular Roth, but you could do a backdoor Roth.
Yeah, so we could do, because of my wife's 401k plan, we could do a mega backdoor Roth if we, shifted IRA money to the 401k, and then we would avoid that
pro rata rule. Yeah,
the pro rata rule.
Yeah, the pro rata.
Yeah, it sounds like you can do some things, but it would probably require just sitting down and doing a little tax planning. But as it is right now, I think the first issue, the biggest issue, is keep it in the regular now because of your tax situation. Thanks so much for the call. Thank you all for being there. If you want to learn more, go to talkingrealmoney.com.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.